in the UAE, and Brent crude oil is just about, would appear to kick the door down on $80. We'll see if it closes. It's 79 and a bit of change. And clearly, the market has made a recovery. That would be a bit of a wrong word, perhaps, given that $75 was still a fairly serious number. But nonetheless, we seem to have moved beyond the tight range of 75 where we've sat for some time. Is this a breakout or just a temporary drift away from the trend line that we've been on for really some months now? Let's welcome Adi Imsirovic, Director of Surrey Clean Energy. Adi, your thoughts as we go into mid-July and the end of our season, as we reflect on the markets drifting into this sort of silly season, as some call it, in terms of the markets. But your thoughts on the direction of travel this week?
I think I tweeted on the 4th of July, I just dug it out, that I just don't understand why market was still stuck in the 70s. I think the market is going to go way above 80 for a number of reasons. And by the way, I would have disagreed with the majority of people in your survey regarding the reasons for this sort of rally. I think the main reason eventually is the macro situation. I think there was a lot of chatter coming out of the Fed regarding the rates increases recently. I think the general opinion seems to be that we shall see 2 more rate increases, but that's it. I think the market is seeing the light at the end of the tunnel. And I think that's psychologically very, very important for the oil market. When you put that on top of the sort of reasonably tight balances situation and increases in jet demand and everything else, I think the market is having a very, very positive spin on the overall situation. Add to that a bit of OPEC, Saudi cuts, whatever it's worth, we'll have to find out. And overall picture is looking rather positive.
Vandana Hari, founder and CEO of Vanda Insights in Singapore. Vandana, so is this a demand-led move to the upside, that as Adi puts it, the light at the end of the tunnel? There's only 2 more rates after, I don't know, 20 of them, and they still have to filter through and kick us all in the rear end. Nonetheless, your thoughts, is this now a demand optimistic bull forward, or is this a supply tight crunch, Prince Abdulaziz getting his way?
Good morning, Sean. Or a third option to your question, is it a flash in the pan? So slightly contrasting views to what Adi has just expressed. Look, I think crude's sent to a successive 10-week highs, in fact, in recent days. I think it's untenable. Yes, there has been a perceptible shift in market mood, but that's like an hourly phenomenon for the past several months. So we saw a couple of dovish comments from a couple of Fed officials giving dovish comments, but I really don't see what has actually changed. So we talked about perhaps 2 more 25 basis point hikes. But as far as I can remember, for the longest time, well, the last several weeks, the market, that's exactly what the market has baked in. Another 25 points hike at the upcoming meeting later this month, and another one fairly soon after that. See, the main friction or tussle between the market and the Fed has been not so much about another 25 points, 50 points hike, but about a pivot, the market expecting the Fed to start reducing rates soon after. And as in the past few months, the market has come around to the view that, no, the Fed means business when it says it's going to keep the rates high. And a few weeks ago, we heard Jerome Powell saying, do not expect cuts at least until 2025. So look, overall, the economic sentiment, which had been a drag on crude prices, I don't see what has changed unless we see a dramatic pivot in the next few days or weeks with regard to the economic sentiment, with regard to recession fears. I don't see how the prop in crude could continue. I think demand is lackluster, certainly so from China. And yes, OPEC Plus is tightening. But the latest announcements as far as the Saudi rollover was concerned, I think that was pretty much baked in. And as far as the Russian cut is concerned, I think the market is going to take it with a pinch of salt. So I really don't see any reason for crude to be at current levels.
Abhi Rajendran, Head of Global Oil Downstream Markets, North America Energy Research at Energy Intelligence, now currently sitting in India, enjoying some very, very diverse availability of food, which is a wonderful thing that India offers. And your thoughts, Abhi, of Energy Intelligence. We're at the OPEC conference last week in force. I think your CEO and everybody below him was there. Your thoughts on how big an impact this current moment is? Is this an inflection point, do you think, where the demand outlook, the economic positivity that Adi mentions is the driver forward, or this is the suppliers, the OPEC Plus group, constraining and limiting that supply to ensure the upward momentum? Your thoughts?
Sure, Sean. Yeah, and good morning, and thanks for having me on. Yeah, I think we've really kind of been range bound for oil prices since like the end of last year, right? We've kind of been bouncing around between like a $10-ish range. In the first half of the year, I mean, I think the key drivers were macro and supply, where I think macro acted up, turned into a headwind. And so did supply, right? I think you had supply surprises coming from all different sources, ranging from Russia to Iran and other places, despite one OPEC supply surprise cut and then another one. So that kind of saw prices drift lower, positioning. The trend was all lower. So positioning.
We've seen all of that. Where are we going forward? Where are we going forward? We don't need history lessons. We need forward projections.
Yeah, I mean, I think so we've had this little bit of a bounce back, right? I think things were washed up. The OPEC Plus cuts and the Saudi surprise cut kind of flipped momentum. I think where we are right now is probably a pretty fair price. I agree with Adi that I think we're gonna get a kind of a thrust into the 80s, because again, I think this is kind of a momentum market, right? I think things were so washed up. I think there's still more of a run to come. I think it'll be more supply driven over the short term. But I do think there will be limits as to how high oil prices can go. Like, I think if oil gets to, let's say, in the 85 to 90 range, then I would get pretty cautious on prices. I think, the macro still, has more to act up in the second half.
Can we get any crystal ball outlook from the performance of refineries at the moment coming out of maintenance season? Do they give us any indication that we are indeed on a sustainable path upwards?
Yeah, I mean, I think so. I mean, I think especially in the U.S., I think demand has held up pretty well. Refining utilizations and in Asia and emerging markets are holding up pretty well. The Indian market is pretty strong, and a couple of other kind of other key developing markets are pretty strong. So I think there is kind of still upward momentum in prices over the short term. But again, look, once we get to 85, 90, I would be cautious. I think, we're back, in terms of interest rates, we're back, as high as where rates were back in March when things started blowing up, especially in, the U.S. banking sector and financial sector. So I think there's still risk. I think the U.S. consumer has headwinds coming up in the second half. And back to what Avant and I was talking about on Fed and central banks tightening, the year-over-year comps, right? We've seen, kind of improvements in inflation rates year over year. I think those start to get harder in the second half. Right. So, so there's still, this pressure on central banks to kind of keep rates higher. And I think that, that kind of has, chronic effects for the economy. So I think there's
that filtering through is still, the filtering through of those substantial rate rises over the last year, I think is yet. I mean, it's more the 12 months ahead we're going to feel it rather than the 12 months behind. Adi, I wanted to get your thoughts on how technical is this surge forward, Adi? Clearly there was a lot of shorts in the market. They needed cover, so buying long was a technical requirement. Is that what we're seeing now, or is it more than that?
No, Sean, I don't buy this market being short and market being long for a number of reasons. The sort of commercial, not commercial. First of all, the main reason I don't buy that very much, and I don't seriously take much time looking at those numbers, because they are backward looking. They are about a week late most of the time. By the time you get the data, the positions could have changed big time. Secondly, I was involved in filling in those forms, who you are and what you are, and basically what the market considers to be speculative demand and supply is not always the case, and the speculative demand and supply for the lots on the exchanges could actually well be under commercial. I worked for a number of speculative entities in my life, and we're always qualified as commercial entities, i.e. hedging, so we were not even looked at. So that you have to look at the data in a lot of details. Essentially what I think is going on is the drivers of the flat price in oil are the financial situation. So all this sort of, whether Saudis are cutting in August or not, is totally irrelevant in a way, unless they're going to roll it 6 months forward. The people who are buying and selling flat price are the people who are actually looking at the macro situation. And that's why I said it was number one thing, that the perception that that interest rates increases are coming to an end. Even though they are going up, I agree with Vandana, it's not super bullish, but there is a light at the end of the tunnel. There is still a lot of pent-up demand, as we see in terms of travel. Plus, let's not forget, there are some geopolitical risks out there. I mean, Libya has been in the news recently. General Haftar has been complaining again about unequal distribution, and very, very quickly that situation could change, and we could see a loss of a large number of large supply in Europe. So overall, I think that the slight balance is towards the upside. I'm not saying it's anything particularly raving bullish about the market. For example, Chinese demand, I think that's one of the key issues here. Since Vandana mentioned that, I agree, China is not doing very well at all. I've said it a number of times to you, Sean, here.
They'll still be buying a lot of oil. They've still been
exactly,
importing,
but
maybe not consuming.
They are bottom feeders. They will buy cheap oil and put it in stock. I think they've been building stocks, and they've been buying record levels, in fact, even though the economy has not been doing very well. But, they have a huge amount of storage available to them, and buying 700 a day to fill up their storage simply because oil was cheap was a good deal. And as a result, we see now Russian differentials picking up a lot, as they've been buying fair bit of crude, Russian crude as well. So that sort of, I don't want to go into another segue of price caps, but already Russian crude has primarily been trading in the last few days above price caps, both in Asia and in Europe.
Vandana, on that point of the price cap and the imports into Asia of discounted Russian oil, India and China, how discounted is that oil at this stage? It does seem like Ural's pricing is creeping up.
Yeah, absolutely. So as Adi mentioned, Russian crude prices have been creeping up. I would suspect they got two sort of waves of tailwinds. One was when it started becoming evident that through May and June, Russia became a little more disciplined to cut its output by 500,000 barrels per day, something it had promised starting in March. And a second tailwind, of course, when last week when Russia announced that they would cut August exports by about 500,000 barrels per day. And indeed, exactly as Adi mentions, the prices in recent days have come very close to the $60 cap. I think one of the price reporting agencies assessed FOB Primorsk Urals at $59.38 yesterday. That's a jump of almost $20 a barrel, compared with the start of this year. Now, I do wonder if, of course, India has been buying huge volumes of Russian oil because of the massive discounts for the past several months. But I do wonder if this Russian decision to cut back exports could actually backfire, because if you look at the Indian refiners, they bought about 2.1 million barrels per day in May. About 40% of the country's crude came from Russia. in that month. And June official data is not available, but our estimate is it would probably come in at the same level or perhaps even a little bit higher. But if you look at Indian refiners, I can see at least 3 hurdles in them raising their intake further and possibly leading them to reduce it, because one is obviously economical. So if the discount shrinks, Urals loses its competitive advantage on a delivered basis to India. They're going to compare it with the Middle Eastern crudes. So, then obviously the intake is going to go down. There is a technical issue as well. Some of the Indian refineries are not that well kitted out with cokers, and we know Urals has a high yield of fuel oil. So if you can't upgrade it into lighter products beyond a point, gasoline and diesel is what is in demand, then you are going to kind of step back a little bit. And finally, it's the sanctions. So this is very interesting that even though exports to India are not by and large using Western services, so they don't technically, Indian refiners don't need to adhere to the cap, but Indian banks, that facilitate the payments are being extra careful of US sanctions. So the banks have been insisting that refiners demonstrate that the FOB price was $60 or below. So I think that could become a hurdle as well going forward if prices continue at current levels or continue to creep higher.
Abhi, I wanted to get your thoughts on where the US industry is at the moment. Obviously the rate hike cycle is having little impact, it would appear, so far on the US economy, with significant jobs still being created, and the oil production capacity of the US is creeping up. Abhi, I'm wondering your thoughts on the outlook for the second half of the year. Could we expect US production to continue to increase and get back to pre-COVID levels and beyond?
Yeah, so great questions. Our view is actually pretty much the opposite on both those points. Let's touch on supply really quickly. Yeah, supply has picked up over the last 6 to 9 months. Maybe outperformed a little bit, although there's been some EIA, data readjustments and whatnot. So, by the way, which have been, kind of revised downwards in their monthly updates over the last couple of months. So there's that as well. But if you look ahead, every indicator points to further and further headwinds for U.S. supply. Yes, it's going to continue to grow, but that growth is going to be kind of more and more challenged. Right now we're around 12.6 million barrels a day or so. Of production, pre-COVID, we peaked at around 12.9, 13. So we're going to get back there. But, getting back there is going to be more and more of a huff. Exceeding it, I think, is going to be a pretty challenging proposition. So I think US supply growth, certainly rolling over, not just for oil, but for gas too, is going to be a key feature. And then on your other question on demand, I've been saying this since the end of last year, because this is a really weird cycle coming out of COVID, that you're not going to see, unemployment rise. You're not going to see jobs data getting hit, as you see a tightening cycle this time, because, there are temporary jobs, there are secondary jobs, tertiary jobs that people are taking on that really kind of fudge the data. So you're never going to see the labor market really kind of crack like you've seen in past cycles. But the U.S. consumer is still struggling at the core, like the core middle class, kind of lower middle class consumer is struggling with mortgage payments, car payments, things like that are, the big chunks. It's not gasoline prices. That's pretty much irrelevant to a consumer. Those big chunks are a challenge. And like I said before, looking ahead in the second half and into next year, a lot of those excess savings and things like that have helped the consumer out, basically outspend what they're earning over the last couple of years, are going to dry up. And you're already starting to see this, right? I mean, as Adi mentioned earlier, flight, travel is at an all-time high, US flights are doing great and things like that. But if you look at other factors like Airbnb usage, like Disney park usage, other things like that, the consumer's already, feeling that strain. So I think that's going to be a headwind for oil, for demand in the second half and into next year.
Let's go to the survey question and just sort of take on this point that we were discussing earlier. This week's oil price rise is more demand-led by end-of-rate tightening cycle rather than OPEC plus supply constraint. this is a demand optimism outlook, as Adi has shared, or is it OPEC supply constraint, and the macro eco picture remains as guided by the World Bank and IMF as one of very low growth this year and many countries facing possible sovereign debt challenges? Agree or disagree, this is demand led rather than supply constraint? Adi and all of our panelists, as we now go into the sort of off season for the Daily Energy Markets podcast, we kind of are getting the pulse from each of our speakers on a kind of a longer outlook for the rest of the summer, the 2 months ahead. What will be guiding, what will you be watching, Adi, over that sustained period? We start this week. It would appear like the year of two halves has arrived this week, Adi. Is that your sense? And what will you be watching to ensure it's going to sustain?
Well, normally, historically, at this time of year until almost about end of August, markets tend to be relatively quiet. A lot of traders go on holidays and close their positions and don't carry big positions on their books. So in the absence of any geopolitical issues, I would expect market to hover between $75 and $80 a barrel. I think what I'm looking at primarily is the macro situation. We're going into the earnings season, I think, and sort of economic indicators, PMIs, and so on and so forth. So I think the macro picture is going to be absolutely essential. I think in terms of supply and demand, we know where we are roughly. There are some disagreements between OPEC, IEA, EIA data, but generally we expect a healthy demand picking up in the second half of the year, but we also have fairly good supply. There's no doubt about it. Just since I mentioned supply, going back to Abi's point, I mean, everybody's going on about US output sort of slowing down. Yes, but there's still every time we talk about it, we hit record highs. So, you know,
still the world's largest.
Yeah, I mean, we're talking about 12.5 million barrels right now, and EIA is talking about even higher, 12.85 next year. So these are not small increases. They're like 200,000-300,000 a year. It's not too bad at all when you add that on top of Canada, Guyana, Brazil, and everything else. Most of this incremental demand is covered by non-OPEC supplies, which still
non-OPEC plus even.
Absolutely. Very good point. So I think unless we see a big pickup in demand, I think OPEC is going to struggle. And there is a very small probability, I must stress, very, very small probability, but I think we should all think about longer term scenario. I'm very, very interested in this. What happens if Russia doesn't cut? What happens? What is Saudi Arabia going to do? Are they going to lose patience and we go back to March 2020?
Is there anything, Adi, is there anything in the natural annual cycle of Russian consumption that would make a cut appear like it's a cut, but actually it's just because of increased domestic consumption? Or like in Saudi Arabia, we see in the summer, they burn up to 1 million barrels of oil still for power generation. Is there anything in the annual cycle of Russia that would disguise that?
Not to my knowledge, but obviously there is a war, which is pulling a lot of.
And they have said they're cutting from exports.
That's right, but that's going to be a problem for OPEC and the Saudis to actually figure out what Russia is doing, because Russia has this. I mean, when they say they're going to cut production, well, first of all, you can't verify that. You can only look at the export figures. But what if they could cut export of crude and increase substantially export of product? Does that count? You know, I don't know. So there's a lot of that flexibility what they have, and what, you know, one thing that a lot of people don't realize about Russia, even though you have an autocrat like Putin, it's not very easy. You have a large number of players involved in that market. To coordinate some sort of coherent cut is not going to be easy. Of course, they can use Transneft as an emergency measure and basically not give people allocations for export, but they have to be careful about that, because as soon as storage starts filling up, these companies, have to do something. You don't want to damage the fields and so on and so forth. So it's not an easy thing that a lot of people, it's not like Saudi Arabia cutting 500,000 because they have, 80 million barrels storage and they just put into storage. Russia doesn't have that.
Vandana, your thoughts over the summer months from the vantage point of Singapore, looking out across the horizon with China, Philippines, Indonesia, all of the big Asian economies?
Yeah, so I expect prices to be quite range bound as well, but a little bit lower than the range Adi has offered. I think probably a midpoint of around $75 and perhaps $2 or $3 on either side of it. I think the very hawkish narrative of the Fed, the ECB, higher for longer, I think those concerns and then what sort of a economic impact they have, recessionary fears, I think all of those will continue to dominate the broader financial markets, but I think oil as well. I think Russia and its compliance is very, very interesting. I would keep a very close eye on it. I'm inclined to speculate even if Saudi Arabia might have asked Moscow to go with a cut in their exports rather than production, simply because that would be more easily observable by Saudi Arabia, and the rest of the OPEC members, at least until the third-party independent surveys on production come in. But there are so many questions around exports. Adi has mentioned a few already. Also, what if Russia translates it as, okay, we will export less crude, but we'll simply refine more of it. We don't need to change our production much, and we'll just export more refined products. Refined products are potentially not on the radar of OPEC Plus members. So what happens here going forward? Is there scope for more tensions between the two? I would keep a very close eye on that.
What about I just wanted to get your views on China imports, which have been quite solid in recent months, given how cheap, quote unquote, the discount. The Brent was obviously on a lower end of 70, as well as the discounted Russian Iranian crude. If Brent was to rise above 80, is it likely that China would back away from imports, given that they're not consuming this oil, they're putting it into storage, at least in marginal excess?
Absolutely, Sean. I was about to jump onto China. Exactly.
Yeah.
So yes, I think there is a degree of demand elasticity, price sensitivity on the part of China. I wouldn't expect them to go on a buying spree to the extent they have done in the past quarter. I would say if prices are above $80 a barrel, if they are unable to get good margins on the product exports, that's another reason for the independents perhaps not to buy as much crude. And you mentioned jump in Chinese crude imports, so about 6% higher year on year in the first 6 months of the year. But they have stashed away quite a bit of crude and they have increased their refined product exports as well. So at the end of the day, it doesn't translate to exactly that quantum of jump in domestic fuel demand. So, on a global level, it all sort of doesn't move the needle much. Overall, macroeconomic data in China, I'm keeping a very close eye on that. Manufacturing is in contraction 3 months in a row to June. There's a lot of disinflation in the country, which clearly shows producer price disinflation, especially, which shows lack of appetite, buying appetite. And exports are suffering as well. The real estate sector remains in the doldrums. And we're getting a lot of anecdotal evidence from people based in Singapore, business people who are finally have been able to visit China again, get a sense of how things are moving on the ground. And, across the board, they tell me that the consumer sentiment is immensely weak. People are tightening spending. So I think the pent-up demand bump is probably behind us. They're not even willing to invest in the property sector, so they just don't have.
In many ways, the difference between the China post-COVID picture and the West, US, Europe, is that Chinese consumers not coming out of post-COVID with a free check from the government, and so savings are being treasured for the uncertain future. Let's go to the last word for Abhi, with the survey results seeming to confirm, at least in this small group here, and we'll post it on social, that Adi's sort of outlook is getting some support. Abhi, your closing thoughts on looking into the summer months. You're in India right now. Of course, it seems all things in India are very, very positive, very bullish.
Yeah, I think, in the next couple of months, as Adi mentioned earlier, we're going to have thinner trading, thinner volumes, and a lot of people on holiday. So I think, maybe some more exaggerated moves, one way or the other. I still think, the next, sort of, $5-7 move in these next 1 or 2 months will be higher. I think we're more likely to see, 85 than back down to 70 or below in the next couple of months. But I do think that, as you kind of come out of the summer in the next couple of months, digesting Fed and macro and all these other things, that, you're going to have this, kind of resurgence of this concern around inflation and what central banks have to do, and what, how much they're not doing enough. And so I think that kind of hits a ceiling. I do expect prices to come back down. I think we kind of end the year closer to 75 than 85. That's kind of how I see things play out. But we'll see. Yeah, I think the macro story and drama, while it seems like it's sort of settled out for now, and sentiment is better, I don't think that's over for the year.
Well, in some ways, we focus on the positive sentiment of job growth is nearly increasingly bearish for oil markets, because in essence it gives the Fed the ammunition to keep on going. So as Adi has indicated, two and done, I think, may be a question mark, given how resilient labor numbers are, and the core inflation rate stuck at 5%. The Fed might have to get the sledgehammer out to get it down 1% at a time to 2, 3 whole percentage points still away from 2% target. I'm not sure 25 basis points gets you to that kind of journey. So I would be watching signals on the outlook for on one side job growth, and then the impact that has on giving the Fed more ammunition to keep moving forward. We're going to wrap it up there. As we started, Brent trading in Asia this morning, just a little bit below $80 a barrel. Can it get above that number and hold? Big question there. And in the meantime, just to thank you guys, Adi Msirovic, as always, star contributor to the podcast. Vandana Hari, of course, a star contributor and also a occasional moderator. We really appreciate your participation this season. Vandana, have a great summer holiday. And Abhi Rajendran, thank you so much for joining us this season, and hopefully you'll be back and with some of your other colleagues at Energy Intelligence. We really appreciate our partnership with you and the great work that you guys do, and a shout out for Amina Bakr and her big award last week at the OPEC International Seminar. We just had posted our last halftime talk of the season with Arjun Murthy, who gives us some very useful insights. So if you've half an hour, I'd highly recommend that. All the best. And just to close out on that last point, the first point Abhi was making in the green room before we came on, when can we all meet together? Well, of course, it's only one place, and that's the Fujairah Energy Markets Forum on the 10th and 11th of October, our 11th edition of the Energy Markets Forum in Fujairah, and we're hoping to have all of our commentators there. That would be awesome. All the best, everybody. Take care.
All the best.
Thank you.
Thank you.
Bye-bye.
Thanks, John. Thanks, everyone.